what a bursting bubble looks like. Look, it may be a little bit dramatic, but certainly a hot topic and the subject of much debate out there today. In fact, precisely what the New York Times is talking about this morning. Welcome to Futures Now. I'm Jackie DeAngelis. This is a very special show. We are calling it Boom or Bust, and we are going to talk about what is going on out there right now and bring you some answers with an all-star panel joining us today. First off, we've got Schiff. He is coming to us from Connecticut, and also Jim Murio coming to us from the floor of the CME in Chicago. Dennis Gartman, the commodities king, he is on the phone from Virginia. We'll talk to him in just a bit. But before we talk to the rest of our guests, I want to bring in our first special guest. Marc Faber is calling in from Thailand. Marc, always great to have you on the program. I'm just going to throw this first question out to you. Boom or bubble? What do you think?
Well, I think it's a colossal bubble in all asset prices, and eventually it will burst, and maybe it has begun to burst already. And obviously I've been wrong in the sense that I expected a correction to occur over the last 2 years. It hasn't happened since October 2011, when the S&P was at 1,074. We've gone up in a straight line without a larger correction than 11%. And I think we're not going to have a correction, but we're going to have a bear market.
And what do you think triggers the bear market? I mean, we've seen some declines as of late. Is this enough to sort of get that going, or is it going to be something else?
I want to tell you, you never know what will trigger a bull market and what will trigger a bear market. You only know it after the fact. When the markets bottom out, everything looks horrible, and nobody can think why the markets should go up. And when markets peak out, nobody can believe that it could go down. And we have now an environment where everybody puts faith in central banks printing money, and that therefore asset prices cannot go down.
Let me ask you this, Marc. Correct me if I'm wrong, but I believe the actual definition of a bear market technically is a correction downward of 10% or more. Is that what you're looking for, and how quickly do you think it can happen?
I look for 30%.
Okay, 30%. That is a steep bear market.
Yes. I mean, it's a minor correction. If you can't buy something without the expectation that it goes down 30%, then don't even get out of your bed in the morning, because we have within markets a lot of volatility.
You know, Marc, you've been calling for this for quite some time. Obviously, you've taken a very bearish view. What do you think makes it different now, where we're standing here in July 2014? What's the difference now? You know, you mentioned the Fed propping up the market. It appears the Fed will probably continue to do so.
Yes, the difference is that valuations are much higher, and contrary to what most investors and strategists expect, I don't believe that the global economy is strengthening. I rather think the global economy is weakening.
When you talk about valuation, I'm assuming you're talking about valuation of the S&P 500, for example, but a lot of people are saying, you know, it's time to really not necessarily focus on valuation, but look at companies, for example. Earnings expectations for this season are quite high, and companies appear to most analysts right now like they're going to meet or beat expectations. So if that's the case, and if earnings go well, and if corporations are doing well in this environment, does valuation really matter the way it used to?
Well, I've never met any analyst who predicted a downturn or a significant downturn in earnings, except for analysts that work for short sellers. And the fact is simply that earnings have been boosted by stock buybacks, not by revenue growth. And another fact is that earnings are grossly inflated because we have artificially low interest rates. So I wouldn't rely so much on the analyst expectations as of today.
And what do you think the chances are? You know, there is some buzz out there that the market is sort of has gotten a little bit top-heavy, perhaps. Maybe the Fed might consider raising rates sooner than expected. Do you see that in the cards?
Actually, in my scenario, where the market goes down, I don't think that the Fed will increase interest rates at all. But there are other issues that may put a weight on the market and keep prices or push prices lower. I think we have in the White House a very poor president, and that may lead to some political issues in the U.S. domestically. B, we have numerous geopolitical issues to consider, and C, we could have potentially a much higher oil price.
Marc, I want to bring in another voice on the market here. We do have Peter Schiff with us today. Peter, a question for Marc right now.
Well, I think we're saying the same thing, just with a different accent. Although, Marc, do you think, though, if the Fed tries to blow more air back into this bubble, and I would agree with you that it's a bubble, but if the Fed is determined to fill it with more air, don't you think they may succeed in slowing down the process, and so the nominal decline in stocks may not be nearly as great as the decline in the value of the dollar?
That is entirely possible. If you would increase the asset purchases by the Fed, say you go from asset purchases of nowadays, say, I don't know, 35 or 40 or 50 billion dollars a month, you go to 500 billion dollars a month or a trillion a month,
that's not
that everything will be inflated. But I believe, and this is what I have to say, the only sector that stands out, in my view, as attractive, and I said it at the beginning of the year in a Barron's interview, are the gold and silver mining stocks and platinum and palladium. And whereas the S&P is just up 6% this year, the GDXJ, the junior gold mining
I agree with you. The only
index,
place there's not a bubble is in gold, and that's the only place that most people on Wall
Correct.
Street think they see one. They're
Correct.
oblivious to the actual bubbles, but they're overlooking the value in gold and gold mining stocks.
The
Peter,
biggest bubble.
I definitely thought Peter
bubble.
was going to say that. Marc, you agree too, but I also want to bring Dennis into the conversation here. Dennis Gartman, if investors are out there and they are looking for a flight to safety right now and they want to get away from the stock market, is gold the place to do it?
Well, it depends. Probably yes. Probably this is going to be one of the rare times that I will actually agree with Peter Schiff on almost anything. But, yeah, I think gold mining shares are probably inordinately inexpensive by almost any measure. Normally, I would say go buy gold itself. I'm not particularly bullish of gold. I'm not a gold bug. There are times when one should own gold. There are times when one should have zero amount of gold. This is probably a time when you should have some, but for the public, I think looking at gold mining shares, which have underperformed gold bullion over the course of the past 2.5 years, and only in the last 6 months has that spread between bullion and mining shares begun to move back in favor of the mining shares themselves. Probably this is the first time when you can say, go buy the mining shares. And if you're going to do that, make sure that you buy the big names. Make sure you buy the ones that are going to be liquid and going to be around. Buy the Barracks, buy the Homestay, buy the ones that have been here for a long time. Whatever you do, public, please don't go looking at the
Homestay has been around for a long time. I think they were bought by Barrick a long time ago. They were.
Yeah, I understand. But look at Barrick, look at ASA, look at the larger names that have been around for a long time. The public tends to get involved with fly-by-night mining shares, and please stay away from those.
Gentlemen, I will bring it back to gold in just a minute, and we will get to a gold trade later in the show as well. But I do want to bring it back to the stock market here, because a lot of investors are looking at this market. They are kind of concerned. I want to sort of go around the horn and get an idea from each of you. You know, we've seen situations before where we think that the bubble is going to burst, and it doesn't burst. Are we ill-advising investors right now to sort of fight this market and be short when it could increase a little bit more? I just want to get everybody's take. Marc, you first.
Well, first of all, I'm not advising that people be short the U.S. stock market, because I'm afraid of a lot of money printing. I don't know that it's going to get up to 500 billion or $1 trillion a month, as Mark is suggesting. But
right.
the Fed could certainly go to $100 billion, $150 billion. And so I'm more worried about the downside risk in the dollar. And so I don't want to short the market, because when you do that, you're exposing yourself to the dollar. I'd rather be long to things that will go up as a result of all the money the Fed prints to stop the stock market from imploding or to stop the real estate market from
Peter,
going down.
I mean,
so
you've made the point.
Gold. I'd rather own certain foreign stocks than be short the U.S. stock market.
Right, and you've made the point several times on this show and elsewhere as well that you are a gold lover. But, Mark, I want to go back to your thesis, because you are calling for a market correction of 30%, a true bear market. Obviously a very bold call. You've made that call before. You have been wrong. So I ask you this.
I didn't say 30% before. I said correction of 10 to 20%.
Okay, so this is
Actually,
the first
Mark,
time you're saying 30%. But, you know, really for investors who are out there, they've watched this market go higher and higher every day. I've watched it myself. Every time we introduce the show, we say record highs on the S&P 500. We can't believe that we're saying it again. Are we ill-advising people to not really ride the momentum wave here?
Well, the point is the indices have gone up, but I would challenge you. Most people haven't made any money this year because, first of all, the Russell 2000 is flat for the year. And a lot of stocks are not up, but down meaningfully, from Facebook to Yelp to Twitter to LinkedIn and so forth. So a lot of people have actually lost money in this rally. The indices have been driven by very few stocks. If you look at the 12-month new highs, it's a very limited number.
That's true, but I think most people out there, especially with volumes being this low, we can assume that you really don't have that many retail investors in the market. Certainly, maybe not like you once did, but you have to assume that funds are diversified when they're buying.
Yes.
Yeah, that's because they're spending all their money at the supermarket.
The retail investors, they've been killed after March 2000, and then the Fed killed them a second time after October 2007. So I would say the Fed has done a great job at eliminating wealth from ordinary people. And you asked me about bubbles, and I want to return to this subject. The biggest bubble is in the ego of the academic knowledge of Fed governors. I've never seen a group of people as ignorant about real life, but talking in academic terms nobody understands, and wobbling around as the Fed's members.
All right, so if you're worried about that, Marc Faber, are you willing to go out on a limb here and tell me that you're the most bearish that you've ever been?
No, because I'm aware that, as Peter Schiff said, they may print and print and print. But that's why, in this environment, I always advocate you hold about 25% of your assets in cash and bonds. By the way, this year, long-term U.S. government bonds have outperformed the stock market. You hold some in stocks, and you hold some in gold, and some in real estate. But the shares I hold are in emerging economies. And by the way, this year, Vietnam, Thailand, Philippines, Indonesia, India are up between 15 and 25%.
All right, Marc Faber.
The U.S. market is the laggard so far in 2014. 2013 is probably the last year the U.S. stock market is going to outperform emerging markets or other developed markets in other countries. But I would disagree with Mark. I see no reason to hold any U.S. Treasuries. Yeah, you might squeeze out a little bit more in the rally, but it's certainly not worth the downside risk, especially since all they amount to are IOU dollars. And if the government's going to print a lot of money and repay its debts with near worthless money, why go down with that ship? I'd much rather own the foreign stocks or the precious metals and don't lend any money to the U.S. government, because either they're not going to pay you back or they're going to pay you back with money that buys very little.
Yes, Peter, I agree with you. I think eventually sovereign debt will be pretty much worthless. But I have to have a diversified portfolio for me and my clients. And so I hold some U.S. dollars, and I really can't see how the euro would strengthen a lot against the U.S. dollar. It may strengthen somewhat, but not a lot, because if the euro strengthens meaningfully, they're going to print as well in Europe, the same in Japan and so forth. So for that reason, I hold gold.
All right, Mark, we are going to have to leave it there.
On that note, I agree with you.
We all do.
But there are other indebted
know
sovereigns.
you two agree
if you
on
want to
that
buy
one point,
sovereign
for sure.
debt, you can look at other countries that are better credit risk than the U.S. government.
Who's a better credit risk than the U.S. government? Please, come now.
Just about anybody.
Gentlemen, I want to move the conversation along. Mark, thank you so much for calling in, but I do want to get to...
Thank you.
I do want to get to a trade here. Jim Uriel, come into this conversation. You heard what Mark had to say. Dennis is piping in. Of course, Peter has his view. What is a trader doing right now with the S&P 500?
Okay, first of all, I am short-term negative on the S&P 500, but I don't believe we're in a situation where a bubble's bursting. The two bubbles I've seen were characterized by mom and pop and next-door neighbors and uncles borrowing to buy tech stocks and borrowing to buy homes. Those are the people who have to react when the margin calls happen. We've seen a lot of institutional leverage, but we haven't seen that sort of leverage too. That being said, and with all due respect, I am somewhat negative on the market just because we've come so far so fast. So I am short-term negative. I think we have a bit of a correction. I've said this before. Sometimes it pans out. Most of the time it doesn't. I want to be a seller at 1959 SEP S&Ps with a target of 1943 on the downside. If it trades 1969, that's where I'd wash myself out.
All right, let's go ahead and bottom line.
Just because Main Street hasn't joined Wall Street's party doesn't mean it's not a bubble. I've been calling this the bubble for the 1%. You're right. The average investor is too broke. He's spending all of his money at the supermarket. He's got nothing left over for the stock market. But we do have a bubble among speculators. Private equity, hedge funds, they are loaded up on property, and they're loaded up on overpriced stocks. This is a bubble. Everybody doesn't have to participate to make it so.
Yes, and here's my point is that those people react differently when the time comes to sell it. And the popping of the bubble won't be as violent if it's institutional investors with deep pockets.
I disagree. These guys are going to cut and run. I mean, they're not going to ride this thing down. And I think especially in the housing market, individuals had mortgages. But the hedge funds, the private equity guys, they don't have mortgages. They don't need permission of the bank to do a short sell. They can just dump their properties on the market, and they will.
Guys,
I think the Fed is going to have to come to the rescue with a lot more money printing to stop that process from unraveling.
Yeah, Peter, a lot of issues to get here. Just hold it for a second. I do want to bottom line this trade here, wrap up the conversation, and then we're going to get to your favorite topic, which is gold. But for now, Jim is selling the S&P at 1959, targeting a drop down to 1943. Since each point counts for $50, this trade risks $500 to make $800. All right, Peter, back to you. Gold's been kind of quiet the last few weeks. Yes, we had a couple of days with big swings, but we're still trading in this sort of $100 trading range, and we can't break through a lot of these key technical levels. I think, as a matter of fact, today we're back under 1320 right now, not really doing much. Obviously, you've been bullish, and we've had this same conversation on futures now where you'll tell me you want to hold gold, you don't really want to give me a target for the next year, or you think it's going to go up within the next few years, but this is futures now. Traders want to know what to do at this point with bullion. What do they do? Right now, gold's doing nothing.
Well, I would be a buyer. The fact that gold wasn't able to sell off as a result of what was perceived to be much better than expected jobs numbers, I didn't perceive it that way. I look at it as a transition from a full-time economy to a part-time economy, but most people on Wall Street were very impressed by those numbers, yet the price of gold did not surrender any of the gains that it had in the previous week. So to me, we're consolidating those gains. We are putting in a very formidable bottom in gold, and you still have all the naysayers, the Goldman Sachs, the Societe Generale, all these guys that were so negative, calling for 1,100, 1,000. They're digging in their heels. They're just as bearish as they were at the beginning of the year, despite the fact that they've been wrong for 6 months. So you have a lot of negativity, but I think the technical picture is improving rapidly for gold. And when I think we get the GDP numbers that come out for the second quarter, and a lot of people are going to be disappointed by how low that number is, that might be a very big catalyst for a much more explosive move up.
But people were disappointed by the first quarter GDP.
But in the meantime, I think the downside is limited by all the shorts who have to cover.
People were disappointed by the first quarter GDP number as well, and we still didn't see gold bounce that much. What is to say that these numbers are really going to start to impact the trade?
And of course, the weather had played a small part in that minus 3%, but it's an excuse that people believed in. But it's taking a long time to shake all this negativity. Look, I have a gold company, too, and in addition to my brokerage firm, I do have a precious metals company, and our business is off. In the first 6 months of this year, it's about 20% below where it was last year, and I think industry is down more like 40%. So even people that should be buying gold are too afraid to do it because of all the negative publicity that's out there.
One of the negative voices out there has been Dennis. Dennis Gartman, I want you to chime in here because especially in dollar terms, you have not been bullish on gold. So what do you say to Peter?
Well, I've been bullish on gold in the currencies that I think are going to do the worst. I've been bullish on gold in yen, and quite honestly, that's been a far better trade than being bullish of gold in dollar terms. Even if you bought gold at absolutely the worst possible time in the course of the last 2.5 years, you're down. I don't have my numbers right in front of me, but if you bought it in dollar terms, you're down approximately 26, 27%. If you bought it in yen terms at exactly the worst possible time, you're down about 2%. Now, as I like to say, I didn't go to Harvard, I didn't go to Yale, I just went to North Carolina State. But I understand that 2% loss is a little bit better than 25 or 26 or 30. And I look at Peter's talking about the fact that the United States is going to continue to destroy the U.S. dollar. If the Fed continues to expand reserves, which it said it's not going to do, I take them at face value right now. They may lie. I doubt it. But we've also had the ECB come out and tell us last week that it will, in fact, be expanding reserves. I think you're better off being long of gold in euro terms than you are being long of gold in dollar terms for the long foreseeable future, because gold in euros is, in fact, breaking out on the upside.
I would disagree. You know, I think the dollar has a further to go down relative to the euro. As bad as things are in Euroland, they're worse in the United States. And I think, you know, we are going to push the envelope much farther than the Europeans. I think as inflation begins to accelerate, as Europe measures it, they are going to be quicker to try to tighten than the United States. No matter how high the official inflation numbers get, Janet Yellen will just dismiss it, explain it away. She's going to call it noise. She's going to say it's good for us. But the Fed will do nothing to contain inflation.
She's already dismissed
that is not going to be the case in Europe.
And that got gold traders a little bit nervous. That is why we did see that big jump that day, that $70 move that we saw on gold. But, gentlemen, I do want to take it back out to Jim in the pits. Jim, you're watching gold very closely as well. Give me a trade here. What are the guys saying? What are you doing with gold right now?
First off, if you look at the big three central banks, the U.S. Fed looks downright responsible when you compare it to the ECB and the Bank of Japan. And I think that's one of the reasons that gold hasn't done well on the upside. Now, if you take a big step back, you realize that all three of them are being irresponsible, and you probably should own gold. The fact that since it broke out of that downtrend a couple of weeks ago and has kind of consolidated, to me, is a fairly bullish technical pattern. If it trades 13.21 again today or tomorrow, I think it's a spot to buy it. And the short-term target is 13.42, and I know these guys are talking about a much bigger, longer-term trade. If it trades 13.06 on the downside, I still think that's why I watch myself out, and I still think that market position rules the day, and people will be selling gold.
Okay, so short-term, if you're watching gold, what you're saying, sort of the vibe from the pits right now, is that we are going to get a little bit of jump. Let's go ahead and bottom line Jim's trade here. He's buying gold at 13.21, targeting a bump up to 13.42. Since each point counts for $100, this trade risking $1,500 to make $2,100. All right, my thanks to Peter Schiff, as always, for joining us for the gold conversation. Always very lively and great to have you on, Peter. Meantime, I want to move on and talk about corn prices, because corn getting hit pretty hard, not seeing these levels since 2010. Dennis, going to take you to task on this one. Back in February, you told us that you really liked corn. It was your favorite commodity. You came back on in April. You said you were willing to double up on that trade. Take a listen here.
I like corn. Corn looks like it's made its lows. If you had to buy something, go buy some corn.
Honestly, I don't think it's overdone at all. I think the fundamentals of corn are getting stronger and stronger by the day. I continue to be bullish of corn. I'm long the corn market.
All right, Dennis, you know I love you, but the facts are the facts. You said it. So what do you say now about corn?
I think by the end of May, I started to go exactly the opposite direction, because the corn crop started to look very good. The weather had turned spectacularly good. The amount of corn put into the ground was larger than anybody had anticipated, and we've had wonderful, wonderful rains. And yeah, there's not a question. I was bullish of bullish of corn in February, March, and April, absolutely. But by the middle of May, wait a minute, the weather is such that this crop has gone from being perhaps a 13.25 billion bushel crop to a 13.75 billion bushel crop to now a 14.25 billion bushel crop. And for the past month, I've said we may have the possibility of a 15 billion bushel corn crop. So no question, I was bullish of corn earlier in the year, but it's been quite some period of time that I was, and actually in the past 6 weeks, if you've read my stuff, I've been overtly bearish. So no question, I was bullish of corn early this year, absolutely.
All right, so you are allowed to have a change in your point of view.
Sure.
Meantime, Jim, I know you're watching corn. I'm wondering if you think we've sort of bottomed out here. In terms of a corn trade, how would you look at this right now?
Okay, I'm definitely going to look at it for the long side. Your question about have we bottomed out, I'm not positive of that. I know I look at the chart and I see no point in selling it now. It rains almost every night in the Midwest, and the corn price is priced for perfection in weather right now. To me, it seems like much better to be long it than short it. I know it's trying to catch a falling knife, whatever the trader parlance is.
Right.
But if I'm going to be doing something right now, it sure as heck isn't going to be selling it. I'd be looking to buy it if it trades 411. That's a little higher than here again. That's a small show of strength that could mean to me a bigger show of strength. Target on the upside would be 443. The washout level on the downside be 395.
All right, Dennis, what do you think of those levels, short term?
Well, I wouldn't be surprised if we go down and take out $4 in the not very distant future, and go down and take a look and see how many stops exist at 399. Then you're going to get the almost inevitable dead cat bounce. I mean, you have to. You're going to get one. You can't go down with the vehemence and the consistency that we've seen corn go down over the course of the past month and a half without eventually getting some dead cat bounce. But
right, so it's not a free fall here.
It's been free fall, and the problem is the funds are still egregiously long, and worse, the farmers have sold very little of their corn crops. So the problem shall be any dead cat bounce, any 25 or 30 cent bounce that you get has to be met by farmer hedging, has to be met by farmer selling, and has to be met by liquidation on the part of the funds. So when you
Dennis,
get a bounce, and you will get one, sell into it.
When does the rain become a problem? Is it that not until we pull it out of the ground? Or is there a point that it's too much rain in July or no?
Well, right now, you've had no question you had an awful lot of rain. You've had some ponding up in the Minnesota. You've had some problems with ponds in Iowa. But the other side of the coin is corn in the highland is going to make up for the fact that any corn lost in the low areas that has been out from ponding is going to be minimal. So unless it continues to rain, unless Noah gets his ark out, rain makes grain on a consistent basis. It's going to have to rain until the end of July to do any damage. And we are at the most important part of the year right now. This is silking and pollination period. And if there is a problem, it's that it's a little too cool out there for pollination. But if you start to get 95-degree temperatures again, and it looks like it's coming, I'm telling you, I think you have the possibility of at least a 14.75 billion bushel corn crop, and that puts $3 at the farmer at the end of the year, a very real possibility.
All right, gentlemen. Well, it sounds like you both think there's going to be a little bit of bounce there, but it depends on the timing of that. Dennis is saying that he thinks it's going to get worse before it gets a little better. Jim is looking to buy here. So let's go ahead and get the bottom line on his trade. He is buying corn at 411 with a target of 443. Since each penny counts for $50, he could make $1,600 on that trade. All right, that's going to do it for today's edition of Futures Now. I'm Jackie DeAngelis. My thanks to all of our fantastic guests. We had Marc Faber, Peter Schiff, Dennis Gartman, and of course Jim Urio with the trades today. Guys, great job. Thank you so much. Remember, for more, poke around the website, futuresnow.cnbc.com, and we'll see you for our next live broadcast on Thursday, 1 p.m. Eastern. We'll see you then.